We're in the process of developing the pro forma statements for our financial forecasting project. In doing that, so far we've developed a pro forma income statement using the sales projection and the production plan, and we did that in an Excel spreadsheet that appeared as follows. So down at the bottom, that's the pro forma income statement that we developed, and we took it all the way down to the increase in retained earnings. The next step in the process is item 2, development of a cash budget, and we're going to use the income statement to do that. Most of this will come from the pro forma income statement. Most of the items that we've developed there will go into the cash budget, and so let's look at the cash budget here for a moment. The cash budget, which starts here with our monthly sales number. In the first section, we dealt with the income statement. That covered the first 6 months of the year, and in this instance, we would really like to be able to manage our cash on a little more shorter time horizon. So on a monthly basis, we could do it on a weekly basis. Large companies actually do this on a daily basis, but we're going to assume that the sales differ from month to month, and if we project those sales January through June, when we total them all up, it comes to $100,000, which is exactly what we expected, because on the income statement we recorded sales over the 6 months of $100,000. So we've just broken that $100,000 up into 6 different months. Sales, however, are not the same as cash receipts. If we're selling on credit, well, we're going to collect some of our sales later than, we're going to collect on these sales later, and some of them we may collect in the first month, some we might collect later. In any event, receipts won't exactly match sales, and I'm going to do a little foreshadowing here, and we'll demonstrate this. We're looking at the cash receipts line, which is right here, and we're only going to, over this first 6 months of the year, collect $93,600 in actual cash. So in developing our cash budget, we're going to care about this cash number, and it's not going to be the same thing as the revenue. So how do we go about developing this? Well, we're going to assume that every month we collect 20% of our sales currently, and that the rest of it is collected the next month. So for any given month, let's say in January we had $15,000 in sales, 20% of that's $30,000. In addition, we're going to collect $80,000, or 80% rather, of the prior month, and our total cash receipts then are the $3,000 plus the $9,600. That comes to $12,600. We can go through the same process every month. In February, we sold $10,000. 20% of that gets collected immediately. We collect 80% of the $15,000 from the month before. If we add the $2,000 and the $12,000 together, we get $14,000 in cash receipts for February. So we're going to just do that right on down the line. Now, it's worth noting that when we get to the end of June, we're only collecting $4,000 of June's $20,000 in sales. That means we're going to end the 6-month period with accounts receivable of $16,000. I've recorded that in yellow. We're going to use that again at a later time. In the earlier discussion when we were looking at developing the income statement, the pro forma income statement, we calculated the costs of production, and even before we did that, we calculated the number of units produced. Let's go back and look at that. We estimated that we were going to need to produce 1,015 wheels, 2,020 casters, and our costs of producing these on a per unit basis were given in table 4-4. To calculate our cash budget, we need to go through that process again. So we have the number of units produced, the cost of material for each unit is $10, so we have a total cost of material of $10,150. For the casters, we do exactly the same thing and have a combined cost of $34,390 for materials. Now, that's over 6 months. Over a 12-month, over a on a monthly basis, if we just assume that we're going to engage in level production and produce the same amount every month we have a cost of $5,732. In the same way that we assumed our sales were generated a cash receivable, and we have to collect that over time, we're going to assume that our materials are purchased on credit, so we have an account payable. So even though we're incurring $3,732 each month in costs, that may or may not be the amount of cash that goes out, because we'll be paying our for our materials in the subsequent month. So we're going to assume that these payments are all made in the subsequent month. What does that mean? Well, it means that for our materials purchases, and this is just an assumption, we didn't get this anywhere previously, we sold 4,500, and then every month thereafter, we bought 4,500. Every month thereafter, we have this average amount that we just calculated, but we're going to see our payment always be for the previous month. So these two terms right here, circle them in black, those two terms are the same. So every month we're paying off the previous month's materials purchases, which means at the end of 6 months we're going to have $5,732 in accounts payable left. This line right here represents all the cash flows that we have. So we have those cash flows, the payments for the previous month. The other items, labor and overhead, we're going to assume are paid, and we have averages down here as well. We're going to assume those are paid in the same month that they're incurred, rather than, so there's no accounts payable, there's no wages payable, overhead payable sort of account. We're paying those in the same month that we incur them. And so those are really our costs, our operating costs, our production costs, I guess more accurately. In addition, if we go back to our income statement, we also had some general administrative expenses incurred over that 6-month period. We'll assume that we just simply divide those by 6 to get the monthly amount. We had interest expense. We're going to assume that's paid at the end of the month. Taxes, we'll assume that's paid at 2 different times during the 6-month period, I guess every 3 months. And common stock dividends we'll assume is paid at the end, just like interest is. So we go back to our budget. Those items that are not in the operating activities, our interest expense is paid at the end, our dividends are paid at the end, our taxes are paid in 2 equal payments in March and in June. And then that brings us to a couple of items at the bottom of the sheet here that we see that are in yellow. These are not income statement items at all. we're going to assume that we had to buy some equipment, or we expect to buy equipment that's depreciable in February and June. When we buy it, it's going to require cash, but that cash is, while it requires cash, because we're producing an asset or buying an asset, it's going to show up on the balance sheet. So we have to recognize that there are items that aren't on the income statement that nevertheless, or aren't involved in producing the income statement, that nevertheless are required for developing this this cash budget. So we're going to spend $8,000 in February, $10,000 in June, and the last thing we need to do is sum all of the payments up. Really, we're just adding up, and I didn't go far enough. We're just adding up all of those payments to get the total payments at the bottom. There are a few more in this last period. So we just add up all of those payments and we come up with our total payments. So now we have the total cash receipts that we have in table 10 or 410, and we've got total cash payments in table 413. Before we move on, let's just point out we captured from table 12 the purchases, all of the costs related to production, the manufacturing costs, and from table 4.8, that was the income statement. We gathered all of these items down here except for the purchase amounts, which we're going to see those come up, the new equipment purchases, which we will see crop up again in the balance sheet. Let me take a moment to clean up. Okay, let's move on down, capture this information together. The receipts information, before we go any further, is coming from line 11 here. So we're going to be using line 11 there. But then in addition, the payment information, which comes from line 38, we're going to develop this monthly cash flow. So in January we bring in $12,600. In February we bring in, in January we pay out $11,200, okay, which we see right above. So here's our 11.2 that we pay out. So our net cash flow, we're going to have $1,380 more coming in than going out, which is a comfortable thing to see. When we get to February, though, the opposite happens. We only bring in $14,000 in receipts from the table above, and we've got $20,452 in payments, cash payments being made, in part because we bought that piece of equipment. Okay, we bought a piece of equipment for $8,000. And so we're going to have a negative cash flow for that month. In fact, for 3 of the 6 months, our cash flows are negative. In June, we're going to buy a $10,000 piece of equipment. It's very negative then. We buy a $10,000 piece of equipment, and our net cash flow is actually negative $11,955. So what do we do with this information? Well, we now know that there are going to be months when we don't produce enough cash to pay all of our bills. It would behoove us to plan on lining up, we either have to have a lot of cash already on hand, or we need to have a bank loan, a line of credit perhaps, that will allow us to borrow the money when we need to. So let's look at the bottom table here, table 415. The first line of that table is the same as from table 14. So we have the net cash flow. We're going to assume that we have a beginning cash balance of $5,000. So in January we'll have $5,000 to start with. We collect another net cash flow in line 1 of $1,380, and that means our cumulative cash balance is $6,380. So we're very comfortable. In the next month, though, we're going to spend through the entire $6,380. In fact, we're going to spend so much that, absent some other source of cash, we only have $72 left. Let's assume that this $5,000 cash balance is sort of a safety level that we always want to maintain. If that's the case, currently we're going to not only not have the safety amount, we're going to be $72 short of being able to make all of our payments. So we're going to need to borrow some money. So we're going to borrow $5,072. And let me clean up a little bit and we'll work through what's going on here. The amount of the loan every period is going to depend upon the additional amount we're going to need to borrow every period is going to depend upon a couple of things. One, we're going to be borrowing money whenever line 1, we're going to be borrowing additional money whenever line 1 is negative. If we have a net cash flow that is negative, we're going to have to borrow money to cover that, borrow additional money. If it's positive, we're going to be able to pay off some of our loan, and unless we don't have a loan outstanding at all, in which the cash balance will rise. And we want to always have at least $5,000 in cash. So in February, we borrow $5,072. That allows us to pay all of our bills and still have $5,000 left over. In March, we're going to have to borrow money because we have a negative net cash flow. We started with $5,000. We're going to have only $1,045 if we don't borrow any money. So we're going to borrow another $3,955, and that is just going to be added to, let's clean this up, the $3,955 will be added to this $5,072 we borrowed the month before, and now we owe $9,000. $9,027. But we still have $5,000 in cash on hand. In April, the tide turns for us a little bit. In April, we actually have a positive cash flow. We're going to be able to pay off some of that $9,000 loan that we had. How much? Well, we can pay off $4,548. So we'll show that as a negative amount for the monthly loan, paying off part of that loan, and we're left with a new loan amount that's outstanding of only $4,479. In May, we have even a better May, $10,000 in extra cash coming in over what we expend, and we're able to pay off the entire loan amount at that point, and we actually see our cash balance rise to $11,000. So we're finally back above our $5,000 sort of minimum. Having said that, June, we have negative cash flows. It's more than the amount that we have available as our beginning cash, so we're going to be $884 in the hole unless we borrow. So we've got to borrow the whole $884 plus another $5,000 so that we can get to our minimum ending cash balance of $5,000, our safety level that we're concerned with. So in table 415, what we've seen here is we developed the net cash flow, and then the rest of table 415 was really all devoted to trying to figure out when we're going to need to borrow money when we don't. Now that monthly loan amount, you'll see up in this area right here a little formula. I don't know that I can draw above that line. It doesn't appear that I can, but above that line right there, the if statement that we had up above, and that if statement basically says if the net cash flow on line 46 is negative, well, we're going to have to borrow money. How much? Well, $5,000 plus the negative amount of the cash flow. 5,000 plus this negative cumulative cash balance that we have right there. But if it's positive, then we're going to either pay off the whole amount of the loan. This is this minus min thing that I have in the equation. We're either going to pay off the whole loan, or we're going to pay off as much of the loan as we can without falling below $5,000. So that's what that little formula does. It's probably a little unclear. You might have to play around with it a little bit to understand what's going on, but you see it up there as it relates to this particular problem. Let me see if I can reduce it even more. Yep, so now it's up here at the top, right up here. So the last point that I should make is this ending cash balance of $5,000, that's going to be used in our balance sheet in the next step, which will come up in the doing the pro forma balance sheet shortly. In addition, we've got a payable amount, a loan payable of $5,884. So we see here our asset and a liability both shown up at the bottom in yellow. We'll end up using those to develop the balance sheet in the next phase.